We're taking your questions on all matters financial. If you have questions on stocks, bonds, annuities, mutual funds, welcome to the Financial Quarterback, where straight talk meets smart money moves, where we help you plan with all heart and no regrets. I'm Josh Jelinski, your guide to what's really moving the markets this week. Retail investors are powering a historic market surge. The Fed is stuck in a standoff, and tariffs are back on the table. Are we riding high or heading for a fall? Have a question? Call me live. 888-988-JOSH. That's 888-988-5674. Or visit Jelinski.com to schedule your free financial strategy session. Are we live on Twitter? Taking your calls? Okay, we are live. So if you have a question on Twitter, type it in the chat box. Tariff trouble returns. Should you worry? According to NBC News and CNN, President Trump's sweeping new global tariffs are shaking up markets and raising major questions about the future of global trade and your investments. But you know what? The tariffs mean nothing for the market. The market just keeps going up. The Trump administration is back with a bold and controversial move on trade. As of August 1st, 2025, dozens of U.S. trading partners face new tariffs, with rates as high as 41%. Countries that failed to strike bilateral deals by the deadline are being hit the hardest. India faces a 25% tariff on U.S. imports, while countries like Canada, Brazil, Taiwan, and Switzerland are also being penalized. These tariffs are already rattling markets and could pressure sectors like automobiles, semiconductors, consumer goods, and retail. Investors now face a new round of uncertainty as the global trade order shifts. You know, Trump, didn't he hit India? Is they were doing something? What was India doing this week? India did something where they cut a deal with Russia. So Trump slapped them with a 25% tariff. Tariffs range from 10 to 41% impact over 60 countries. Canada, you know, I don't know why he's picking on the Canadians. Like, what do they really import anyway? Maple syrup? What do we get from Canada? Oil?
Hockey.
Lumber? Canada is facing a 35% hit. Brazil, 50%. The U.S. is flexing leverage to rewrite trade on a country-by-country basis. I want to be clear here. I'm against the tariffs. You know why? They are going to affect, a tariff is a tax on your goods and services. If you go to Amazon, what do you see? Costs are higher. I think tariffs are going to make inflation stickier. Tariff warnings expand. Tariff notices have gone out to 20 or more countries, including Japan, South Korea, and Mexico. Countries without agreements will face an automatic 10 to 15% import duty. Who wins and loses? U.S.-based manufacturers might benefit if they can meet demand, but consumers could face rising prices and most likely will. Export-heavy industries abroad are likely to lose ground. Logistics, automakers, and retailers face the biggest disruption. I hear Joanne when I'm talking. I hear her. It's very loud. Markets and your money. Investors are already seeing stock volatility rise, especially in tech and manufacturing. Bond markets may respond to inflation concerns if tariffs feed into higher consumer prices. Supply chain sensitive companies are especially vulnerable. Will this derail the soft landing? Economists worry tariffs could undercut cooling inflation and dampen consumer confidence just as the economy was stabilizing. It really hasn't happened. Consumer confidence is pretty high. The economy is doing well. Now, what sectors or funds are most vulnerable to trade war fallout? Well, I think consumer goods are going to face an increase. Obviously, car manufacturers. And if these tariffs stick, what does that mean for inflation heading into quarter 4? Well, I think inflation will remain stickier. I think that's why Powell has yet to lower rates, because they see all of these potential price increases on the horizon. If you're unsure how to invest in a world of shifting trade winds, we can help. A lot of you are worried. Where does the market go next? Call 888-988-5674 or go to Jelinski.com. Here's what I think will happen. Now realize, I get what Trump is trying to do. He's doing something everybody said would tank the economy, and it really hasn't tanked the economy. So give him credit for that. Also give him credit for the fact that all these countries used us for so many years. He just wants to get a little something back for us. So I don't blame him for that, the 10 to 15%, that America First policy. I think that's a benefit. What I see as potential problems with the whole tariff thing, Jim and Rich, do you guys shop at all?
Yes, I do.
Have you noticed prices have gone up on little things, just subtly here and there? Not just grocery stores, but if you buy cheap crap on Amazon?
Yeah, I seen an uptick a little bit on Amazon. I'm a big Amazon user.
You know what I mean, right? Like,
yeah,
it's like $1 here.
Yep. Yeah, definitely. Yep.
That's what's interesting. Jeff Bezos does not want to, he wants to marry his Sofia Vergara lookalike wife. What is her name? Lauren Sanchez.
Mm-hmm.
So they got married. He wants to enjoy his new wife. What's happening? He does not want to catch the ire of the president for passing on the tariffs to the consumer. So they're not doing their tariff tax yet. Here's what I've noticed. Things that used to be discounted on Amazon, you would go on Amazon, it would be like $200 for a bat. We'll use our bat example. And the bat would be 50% marked off. So you'd buy a bat for $99. Now I'm noticing they're discounting it $20. It's $179.99. Same bat that was like $100 last year is now $170. That's the type of stuff I'm seeing. So they're not raising prices, they're lowering the discounts. The other thing I'm seeing, these little nickel and dime charges adding up. What does that have to do with your money? Well, the market is riding high. Things are doing very well in the stock market, even amidst the tariff hikes. But here's what I think will happen. Market might do well from now to the end of the year. We're going to have some seasonal weakness like we always do in August and September. That old, what's the old adage? Sell Rosh Hashanah, buy Yom Kippur. That generally happens as traders start to sell their positions in August and then buy back after the Jewish holidays. That's typically what I see every year. Do you see that?
Yeah.
Back ever since that Shemitah. Remember the Shemitah?
Yep.
So we had people come in our office. Oh, the Shemitah. Remember that?
Yep.
Did anybody read that book by Jonathan Cahn?
No.
We wanted to have him on the radio show or the podcast. There's this guy, Jonathan Cahn. Famous, I believe he's a Messianic Jewish rabbi. And he wrote a book called The Harbinger.
That was big.
That was big. And then he wrote a
Huge.
book on the Shemitah.
And he's in Wayne, New Jersey.
Right down the road. You know, not down the road,
Not
but you know,
down-
a little bit up, a little bit north of
New
us.
Jersey.
So people are worried about that. Remember, people come in our office and say, I want to pull all my money. It's the Shemitah.
Yeah.
The world is ending. Well, it didn't. But now you should be prepared regardless. But a lot of people are worried about the tariffs. What I think could happen, though, is we have seasonal weakness and a strong rally into the end of the year. And then I think we wake up in January and we go, you know what? Inflation is not cooling. Mayday, mayday. Market goes down. Just like it went down in April on the tariffs, I think we will have some inflation tantrum early next year. I could be wrong. Just kind of me seeing what's out there. That's my real worry about this tariff thing, that it masks as inflation. But other than that, you know, things are looking good. The retail investor revolution is up next. We'll talk about that and more. But call me right now, 888-988-JOSH, for the all heart, no regrets. That's a tagline at our firm, the financial quarterback, all heart and no regrets. What that means is you want a heart-based financial plan. You want something that speaks to your values and what you value in life. You want your plan to be for the people you love and the causes you love. I was just this week with a dear woman who said, you know what, Josh, I have 2 autistic sons. I want a plan for them. So if I am gone, they're okay. And then you know what? I also want a plan for me so I could have a day or 2 off. Around the clock care. She's taking care of them every day. So we're going to put together a plan for her that prioritizes her mental sanity as well as fiscal stability. That's what all heart and no regrets means for her. What about you? Call us at 888-988-JOSH. That's 888-988-5674. Next up, the retail investor revolution. Is it fueling the market or fanning the flames? And we're back. This is Josh Jelinski, the financial quarterback. According to Reuters.com, retail replaces smart money as the Wall Street rocket fuel. And The Economist, a fresh retail trading frenzy is reshaping the markets. Retail investors are now responsible for over 12% of U.S. stock flows, and margin debt has topped $1 trillion. Are we in a new bubble, or is this bullish enthusiasm? You know what I see? I see a retail frenzy fueled by AI-driven trading platforms, social media, and easy-to-access markets. You can just buy stocks on your phone. Individual investors are flooding into stocks. Unlike past rallies when institutional smart money led and retail investors followed, this time individual investors are driving stock markets, and the smart money has no chance to fuel this. Have you seen this? I think this is yet another effect of the Trump presidency, because you got all these institutions, all these stiffs on Wall Street, generally left of center, you know, guys like, what's the guy? We love him. What's the guy's name? God love him. You know, the Scaramucci's of the world who hate Trump. They, what's his name? Stephen A. Cohen. They were selling stocks. That's the thing. There is no such thing as smart money, right?
Mm-hmm.
All these people said the world was going to go to hell 4 months ago. Remember that?
Yep.
And what happened? Nothing
We're still
happened.
here.
We're still
Darn it.
here. Nothing happened. It's like Harold Camping. Remember that guy?
Oh,
The
gosh.
world.
I remember that well.
That guy said the world will end in what, 1999, and it didn't. Maybe he listened to Prince. So, do you know Harold Camping, Rich?
I do not.
He was that guy who sound like this, you know.
Yeah.
And you
And
like,
he used to say, "Thank you for the call. Next caller, please."
next call.
Remember that?
So, the guy was a nut, predicted the end of the world. A lot of people sold their stock thinking it would be the end of the world, and it didn't happen, which goes to show, do not base your financial future on apocalyptic prophecies. Even if you believe a lot of these people are wrong, you know, and Jesus said, "No man knows the hour of his coming." So all these people are trying to predict the day. You hear about this new one with the asteroid,
Oh yeah,
the
it's
Apophis.
2029.
Yeah, the Lord is coming back in 2029, folks. Are you that much of a sucker? It seems like, I guess I am sometimes. I get it. So the thing is, yeah, there's this new prophecy that I think an asteroid will hit the Earth in 2029, and that will be the end of the tribulation, the middle, I don't know. I lost track. I think it's the end. So, but
It'll probably be close to the end. Yeah.
here's the financial. You don't know. See, this is the thing. All these people say they believe in the Bible. The Bible clearly says no one will know the day of his coming, the hour. But then all these people try to predict it. You know why they do? To sell books to gullible people who are sort of hey, I want the Lord to come back tomorrow. Okay, I would love that. However, we got to be prepared for whatever your belief system is. You got to be prepared for the worst and hope for the best. But like to base your whole life on some apocalyptic prophecy, you know, I don't know. Why would you do that? You know, base your whole life on God, your belief in God, faith in God. But it's like you're not even reading the same scriptures.
Snake
But
salesman.
a lot of these snake oil salesmen, like that guy Jim Baker and other people. You know, then the guy was selling, you know, emergency food. You know, it's I have a bridge to sell you. Unlike but what does this have to do with the rallies that we're seeing? All of the smart money was dumb. But you know who's fueling this rally? The dumb money, the retail investor. But as leverage grows and valuations soar, of course, a correction could be near. But what's behind the surge? I would argue this is the same phenomenon as the Trump election in November. A lot of people didn't think he was going to win. He won again. So whoever these pollsters are, right, they go to the same school as the economists. Somebody says you're an economist, run. That's why when you call me an economist, I'm not an economist or a mathematician. I'm the financial quarterback. I'm here to give the everyday retail investor tips on how to navigate this crazy world. Many retail investors are now using risky derivatives like short-term options, which now make up over 60% of the trading volume in S&P options. I would argue that that's not retail. It's probably the supercomputers and stuff. But a lot of people now are back in the market. And I would argue it's because they're positive on a Trump presidency. And I think that's what took Wall Street. Like when we talk to people, they're not that scared about the market anymore.
Nope.
And even in April, because they had a belief that, and I'm not saying I agree with this, I think we're due for a correction, but sort of a belief that the next 3-4 years should be very good for stocks. Margin debt highs, though, could be a red flag. When people are buying stocks with borrowed money, that's generally not a good thing and doesn't end well historically. Margin debt in U.S. equities has crossed $1 trillion, mostly fueled by retail. That's a sign of aggressive risk-taking and kind of reminds me of the 2021 meme stock mania. Remember that? Mm-hmm. The Roaring Kitty guy who bought all those AMC and everything else. But so I could see 2021 be very similar to 2025. And you know what that means? 2026 may be bad. So, because 2022 was not good for the markets. What do you think, Richard?
Well, I think you nailed it, but I got to tell you, I think a lot of the day trader wannabes and using this AI. What do you think? Like there's AI software that are mirroring the politicians like Nancy Pelosi on her trades and all. I don't know. Have you seen any of that? Where they're just kind of mapping the politicians and such on how they've done over the course, and it mirrors their.
Yeah, I don't want to do
Trading.
anything just because Nancy Pelosi.
I would agree, but it's this AI. All the like these programmers are coming out all with
Yeah,
this
see,
AI
that's
trading.
a problem with AI investing. You got to look and say, here's my rule with stocks. We have a great portfolio called the strategic, and by great, I'm not promising returns. What I mean is we at Wealth Quarterback, my SEC registered investment advisor, we comb through the stocks every week. We have a list of about 50 stocks. We go through them, buy, sell in ranges of between 1% typically and 5% of the portfolio. Do we lighten up? Do we go in? We want to be in stocks that you would be okay to hold even in a market downturn. I don't want to do something because some politicians do. I get the idea is, okay, Nancy Pelosi got rich because she had some insider knowledge, right?
Yep,
That may be true.
and it could.
God bless her.
Yeah.
But I'm going to differ here with most people. I do not believe Congress should be paid what they be. I think they should be paid $1 million a year to be in Congress. Why? Congress is attracting low talent individuals. I would want my congressman or woman to be the highest level. Does that make sense? Like CEOs. I think the problem is you get somebody who's a bartender and they say, no offense to bartenders, but
It becomes a popularity contest.
Yeah.
I've always said that. Okay, so
I want the highest paid
I'm gonna
Congress people.
push that even a little higher. Where why is it, especially in the finance
Or we go to
professional.
complete volunteer,
Well-
how the early legislatures were not paid positions. Either totally don't pay them
or volunteer?
or pay them.
But how
the
is it?
highest,
But how
like
is
$1 million
it?
a year?
How is it a specialty career? You need to present a resume with experience and be qualified for it. But you can have any of these positions, including the presidency, and not have any experience ever running a business. It boggles my mind that it's just a popularity contest. Period. But they're in charge of the nuclear.
Oh, yeah.
weapons. How does that work? Like, she was a bartender, okay, AOC. No disrespect to any of that. But did you hear the way she actually got elected? That whole, like, her brother sent in, and this was like on social media.
I don't know. She
just
seems
with-
like a very smart woman.
she
I might
she does,
disagree
but
with
she
her
she
politically.
but she
But
got
I mean, I was joking with the bartender thing, but
no, but she got
got
she got into office like her brother sent her in about audition or something. But your point exactly. Like, let's get the right people that have the experience. I'm just looking for you need to have a resume of experience.
Well,
Get
there
in
you
there
go.
to make decisions. What's wrong with that?
Well, that would make too much sense.
Yeah, I know. Well, that's why they call them politicians. And yes. All right. So, in any event, I do got a question for you, Josh. Just go
Sure.
finish wrapping up this
No,
AI
no,
piece.
I want all your questions.
Yeah. So wrapping up this AI
Richard
piece.
is. I'm going to call him the. There's the Rizzler, the Riddler,
Wait a minute.
The
let me give
Riddler?
you
the Rizzler.
The Rizzler. You're
You
watching
could
too
be
much
called
TikTok.
the Rizzler or the Riddler,
Oh,
or you know how the guy has the questions on him.
Be careful.
That's the,
Question.
that's
I
the
could
Riddler.
picture.
The Riddler?
Yeah.
With the question mark.
If
Question
you were a
mark.
Batman villain,
Yes.
he would definitely be the Riddler, wouldn't he? Who would you be?
He wouldn't be the Joker.
No.
Jim will be the hamburgular.
Who would you be, Jim?
Green
The
Hornet.
Penguin. I thought
Green
the
Hornet.
Penguin.
No, not the Penguin.
The penguin.
The Green Hornet. He was pretty cool.
Who would I be? The Joker? I'd be Batman, but no. But if you were a Batman villain, which villain would you be?
Villain would I be?
You ever watch that
Yeah.
Joker movie? That
Are
was
we talking the
creepy-
old 1950s Batman?
I don't know.
Oh, the series.
Or the
talking the series.
The old
I don't
school
know.
one.
Yeah.
I don't know.
I'll tell you what.
They had good actors in that.
They did. Let's get to my question.
So about
So,
money,
about-
no, but my point is, you would be the Riddler because
The
you
Riddler.
have all the good questions.
I got all. Well, here's the question
The
regarding
Rizzler.
an eye.
I was
I
gonna
love
say the
him.
Quizler.
Hey, if you keep it up,
'Cause
we're gonna
you're
do the 2-minute drill.
inquisitive. Oh no, no 2-minute drill.
drill.
Please save us.
So with AI and your
The
constant
2-minute drill.
the 2-minute
yeah,
drill.
For those
Hey.
of you who don't know, Richard's great idea for the show. If you like the 2-minute drill, comment, share. If you
It's a
don't
2-minute.
like it, comment, share.
Or how about comment on what I should ask for the 2-minute drill? I
Yeah.
ask a question, he's got 2 minutes, but realistically, we got to time him
Yeah.
because his 2 minutes are more like, I don't
20,
know, 20
10.
minutes. Yeah, I know.
9.
So here's my thing with AI, right?
Yeah, but
And
that's
all-
because you ask questions that require amplification. They don't just. You're like term or whole. Well, it depends on annuity or mutual fund. You know,
Wait,
ETF.
is that my
Yankees
voice?
or Mets?
Jim, wait a minute.
That's a
Is
good
that
one.
my
There's
voice?
a good one for you.
What?
Is
ETF. Well, I
it-
got a good one that could be
All right.
answered that way for
Go
your
ahead.
2-minute drill.
Go ahead.
ETF or
Or
mutual fund.
that's a good one.
And I would say generally ETF. And that's
ETF.
quick. Why? Because you can trade them at any time of the day. I don't like.
That was a
There's
good one.
sometimes where a mutual fund can do something that an ETF can't do. But if they could do the same thing, I would generally favor the ETF because the fees are lower. You can trade them in the middle of the day. So generally speaking, an ETF over a mutual fund. See, that would be where the 2-minute drill would be cool because that's a simple question that can be very easily answered.
Okay.
Okay, thank you very much.
minutes.
Financial. No, that was good.
Good night, everybody.
So the AI
Back-
question
back
is
to your
this.
show, Richard.
Back to my show. So
Well, who are you, the financial tight end?
So the
What-
yeah,
who would you
all
be
five
if-
of me. Financial
So I'm
tight end.
financial quarterback. Jim would be the financial center.
I'm the running back.
No.
I'm the running back.
You're
I'm-
the
I'm-
running back because he's
I'm-
loaded to ground. He's
I
got good-
am.
he's
I'm
got
loaded
good,
to ground, baby. Just give me the rock.
I thought you were the
I'd be a
financial
tight end.
tight end.
Tight end. I'm at 5'5".
Jim would be the tight end.
Tight end. I'm a little bit taller.
How old are you? How tall are you, Jim? 6 foot?
No,
5'10"?
I'm 5'10" and a half.
What? How tall are you when you wear your
Aging.
heels?
Are you a half an inch taller than me or an inch taller?
Yeah, but when you age, though, you shrink.
Yeah, no, I feel like I was taller like 10 years ago.
Oh my God. You don't? Do you really?
Yeah, you do.
No, you don't. You just
Yeah.
start hunching over.
No.
Besides that,
You shrink.
your cartilage disintegrates and your bones get closer to each other.
Oh my God.
No, you do shrink.
What a
Listen.
character.
You start hunching over. Let's ask Chat GBT. So that's my question in AI. All your research, we do all this through the investment committee constantly. Do you see any positive things that AI is being useful for besides, just...
Oh, a ton of good things. I
What?
mean, it
In
it
what way?
helps with research. It helps with, like, in terms of investing.
Well, yeah, let me break it down. So I know it's extremely helpful finding data research, but you hear a lot of the, people trying to make, I'm going to invest $1,000, make me $1 million and give me a plan. Do you see it eventually ever getting to that point where you can really just depend on AI to manage growing wealth without a human being being involved? Because it's like I see a lot of, you see BS on Instagram and all this, that it's coming down to that point and people reading. I was just curious about your take since you
I think
ton of
AI,
research
it's
on
like
it.
augmented reality. It will assist you, but it's just like the internet gave us plenty of information, but now people are more confused than ever. It'll be the same type of thing. You'll have, well, who's AI? Will be like a leftist AI, a moderate AI, a right-wing AI, a left-wing AI,
Yeah,
and
but
it's
you
the
made a
same
good
thing
point on
with
options, though. I mean,
investor.
isn't the AI used when they're really, I see so much strategizing for options and stuff and puts and all this. I mean, the AI is used in historics and really being able to
Yeah, but then you'll
capitalize
have
better,
AIs
right?
compete against each other.
I know.
And you'll still need human rationality to decipher
There you
where
go.
those deals are.
Understood.
It's just like you have supercomputers now account for a vast majority of market trading. But that's why, you see these big drawdowns in the market, like in March or April. So you still need a human to kind of look at things and say, hey, here's a good deal.
That's where I think Trump trying to really bring AI and have us have more control versus China? Wasn't that a big thing
Yes.
on the table?
Yes.
In other news, we talked earlier about the reason for tariffs on Canada. So this is the rationale according to Tom. No, actually, according to the president. Donald Trump's recent tariffs on Canada are a mix. I mean, this is from AI, right? So this gives you some data. Why is he doing it? The fentanyl crisis, retaliation against Canadian tariffs, reshoring U.S. manufacturing to encourage Canadian companies to manufacture in the U.S., trade deficit and economic leverage. I mean, I get it. I get why they're doing it. So, that's what AI does. It gives you, a compendium of knowledge, but it doesn't really help you make decisions. Sure, it will in the future, but it's not. It's like robo-advisors. They're not,
You still have to have that vast
you still have to
experience
have rationality,
interpret,
soul.
to interpret it.
You're not going to have AI that has a soul. You're not going to have an AI that has a conscience. So,
Great
to
points.
me, right, when you tell AI, it's saying we should, it's funny, have tariffs on Canada because they're letting in fentanyl across the border. Are they really? I mean, Mexican cartels are using Canada as a transit production hub. Well, wouldn't you achieve greater collaboration by kind of working with the Canadian government and slapping them with a tariff? Then they're going to tax our Canadian bacon more. Okay? So I just find that a tariff will always be kind of put forth to the investor. So I'm going to take a brief break, and when we return, we'll be back with your questions. This is Josh Jelinski, the financial quarterback. If your portfolio feels like a roller coaster lately, let's steady the ride. Or if you want to retire and build an income plan, or maybe you're worried about how much taxes you're going to pay in your IRA when you're retired, or maybe you're concerned about fees and risk in your portfolio, call 888-988-JOSH today. That's 888-988-5674 for the Protection, Savings, and Growth Game Plan. And visit visit Jelinski.com today. I'll be back after these messages. Social media is great. We're now an ASMR channel where I'm eating. Aren't people into that? Like people eating things? Strange.
It is strange, but all the time. Tons of followers. Because you're being natural, man. Real.
It's a little strange.
It is.
I don't want to hear you eating a burger
No,
or.
I don't want to see it either. Maybe you're drinking Ghost or something. That's okay. But you're
Yeah.
eating fries and stuff. But you're a slurper.
Any other question? So we're back. This is Josh Jelinski, the financial quarterback. We're being joined by Richard Widmer in the studio today, along with James Minutella. What questions do you have for me, Richard, before we go to talking about the Fed dilemma? No rate cut, no consensus, a lot of nonsense.
I'll tell you what, if you want to do a quick 2-minute drill, it's going to tie into this whole.
I thought you were moving on and doing something
No,
else.
I am. I mean, here's the
Love
question,
2 minutes.
okay? Being because my
Trade market.
my history of my career is in the housing mortgage. So obviously everybody's sitting on pins and needles with the Fed wanting to move the rate because the general consumer thinks they move the rate lower instantly, mortgage rates will go lower and the affordability will increase. So I get questions all the time on should I buy now or later? I'd like to see your take on that. I know I have a general take, but from a financial standpoint, 2-minute drill, should I buy now or later and wait?
I would buy now. Buy a house now?
Yes, that's what I'm referring
Depends. What region of the country are you in?
to. Wherever.
No,
generally
I think
speaking.
it's regional. I think it
You
depends.
think so? Why
I
is
think
that?
the Florida market's softening. I think the New Jersey market where we live keeps going up and away. Certain pockets of the country are very resilient. Why? Because you had overdevelopment in parts of Texas and Florida and places where it was booming, and now it's softening a little bit. New Jersey, we don't really have much new building going on. Not a lot of new construction. A lot of New York is coming down New Jersey. So it depends. I think real estate is a very regional thing. I mean, do I think eventually the real estate market softens? I guess it has to, right? But you have more and more people wanting to buy homes, fewer homes being built. The only way we would have some type of serious correction, which would lead me to say, hey, wait, is more people start building homes. And I don't see, do you see a lot of new homes being built?
Not around
A few
here.
developments here and there, but not much.
No.
Not much at all.
No. Great answer. I'm always a fan, and I'm going to just say, you say regional, and I agree with that, meaning it's all about the appreciation historics of the house itself. Think of it, as far as buying a house, there's always two foods for thoughts. It's you buy it personally, to want to own and have a family, et cetera, but it's ultimately an investment. But even buying around here, okay, the housing prices are going through the roof, but the continuance, you buy today, it's cheaper than going to be tomorrow or the next day. So big fan of that buying today. And it's depending on the appreciation. If the appreciation is low historically on the sector or regional, then it's not a good time to buy in that area. So great answer. Score.
There you go. 2-minute drill.
2-minute drill completed.
But if that
Two-
asteroid hits, forget
I'm
it.
going to have a 2-minute drill for you, Richard.
Should I sit down?
My 2-minute drill for Richard is...
How many
Can
licks
you
does
be
it take?
quiet,
How many
or
licks does
can-
it take to get to the center of a Tootsie Roll Tootsie Pop?
Can you be quiet for longer than 2 minutes?
Come on, man. You know
That's-
that's a challenge. You know that's a challenge.
That's the 2-minute drill.
I don't think I'm gonna. All right. You know
No,
what?
no.
Mute.
I'm kidding. No, I enjoy.
I know you
enjoy.
do.
So,
All good.
well, you had. Well, what do you think about houses? I mean, part of me thinks I have been waiting for a real estate market correction since 15.
You're gonna still wait. I mean,
It
how
just,
how I
think,
feel about it, I could tell you. I mean, I think of it this way: the whole housing wealth is a leverage strategy, so it's part of the whole financial portfolio. With that said, and as when I always have talked to hundreds of clients, you know, somebody wants to buy a house because they don't want to rent and they're driven personally. It's that I want this type of house, I want the swimming pool, the good schools, et cetera, et cetera. That's valid, that's driven emotionally. But then you got the most important part, which they know it's an investment, right? But
Yeah.
really, is it investment? Do they make it an investment? That's where it really comes into play on knowing the past historics of the taxes, how they increased, what the assessment is, how is the school district's like you're really seeing if that house will. It's like when you're picking a portfolio for a client. Is that going to have true growth now and in the future? And if the answer, generally speaking, say the Jersey Shore, it's blowing up, absolutely. It's growing, I mean, 10% increase. So then if that's the case, and people say, well, we'll wait till it comes down, it's not going to come down.
Well, it will eventually.
Well, you
but
got to think of
just
the
gotta
factors
look
if
at-
it does. If it, like, what's going to make it come down?
I mean, I'm looking at a chart right now, the
Okay.
S&P CoreLogic Case-Shiller U.S. National Home Price Index.
I'm saying it. Yep. Look at it. Look at a jump between 2016. It's holy.
1988, the
Wow.
average home was like a little less than 80 grand. Then it remained relatively flat for the 90s, but then took off, boom, from the 90s to 2006, and then 2006 to 2012
That's the dip, right?
was a strong dip.
Yeah. That was the
And then it kept
implosion.
going, boom, boom, gangbusters and then you have COVID really just.
Well, that's because,
This
I
is
mean, the
crazy. From
affordability.
COVID,
That's when rates dipped into the
COVID
3%.
was 213. The average price was 213,000 when COVID started. Now the
now
average
look at
price is 331. Now there was a dip. It was a pretty significant dip from 308 to 292 in January of 2023 as rates started to come up. But then and people said, "Oh, that's the crash." Then it kept going up.
Well, I'll say this now, driven by rate wise. So COVID, you got rates in the 3 percentile, the affordability through the roof, because you know the Northeast, if your average sales price, who knows, could be like, you know, high 300s, low 4s. So the affordability is huge. Then that dip, then you had, well, I won't say about politics, but rates went from 3s to automatically jumping in the high 6s to 7. The affordability, everybody white knuckles on the wheel, did nothing, and then here we are. We're still waiting for a reality of a settle.
No, I mean they needed to go up though. I mean,
But
it
not
had
that
nothing-
drastic, though. That just took everybody out of the market. It could be like from 3 to now could be, you know, 5, 6, 7 years, not in, you know, 30 days. You know, that's
so I'm
what it went
looking
nuts.
at the core price index. Sometimes you can go by. Then there's something called the 20 city composite. Interesting. When you do the 20 city composite home price index, it's starting to cool. Looks like we're headed for a little downturn there.
That's interesting.
So maybe that would say wait.
What?
But that's what I'm saying. It depends on where. Now, if you look at New York, boom. Doesn't look like it really is going to. It has a
Now
little.
that's super interesting that the prices are in, and that's the entire New York, obviously. Can you break
Then
that
you
down
can
to a
go
city?
To LA. LA looks like it's headed south. That's kind of. So you can kind of go. I'm on the fred.stlouis.org website. You can see, you know, condo price for New York. You can see all transactions. That looks like it could start heading south, but not much. You look at California, Texas. Texas is starting to plateau. And so you can kind of look through different lenses. They have Florida in here. I don't see. There's a lot of I'll take a look at. You can look at different regions. So you can look at USA as a whole, Texas, Indiana, California, Pennsylvania, Ohio, Georgia. Doesn't show you Florida, which would be interesting to see.
That would be, but just a good
Phoenix right here. Okay. Active listing count. The Phoenix Mesa. So listings are declining after going record low, then a record high.
Everybody's hanging on the house.
And
that's another tough thing when they talk about the inventory, because most people refinanced in that 3% mark. Who wants to sell and purchase at the 7?
yeah, it'd be better to just rent your house out if you have a 3%
That's
mortgage.
exactly.
That's
So
what a
when
lot
we,
of people say.
yeah. So when to buy or rent, good insight. It's always great to buy because it'll keep going up, but you got to make sure that it's going to have that longevity to increase in value, just like the portfolios.
Wonderful.
Wonderful. And that
So how
my
do you
2-minute drill.
protect newer investors from getting burned in overbought markets? I want to be clear. If you're getting this frenzy, I got to buy now. Dollar cost average in. If you have 100,000, maybe do 20,000 this month, 20,000 next month, 20 over the next 5-6 months. Kind of a measured approach to buying in the market. And should margin be used? Should you loan money to buy stock? Well, there was one guy I met who's a radio listener who bought margin and bought a ton of margin to buy Apple. This was when it was very low and made a lot of money. I think the guy made like $8 million off Apple. But now he's probably lost $2 million off an Apple. So the point is, should margin be used? I generally don't like buying stock on margin. Don't recommend it. You ever see the movie It's a Wonderful Life? I always think about that. Now, if you're very sophisticated, you can certainly use margin as a way to get leverage on a position you believe in. But for the general population, I would say no. Up next, the Fed's dilemma. According to Yahoo Finance and NBCNews.com, the Fed is keeping rates steady, but officials are deeply divided. What does this mean for your money? The Fed has left rates unchanged for the 5th straight meeting, but internal divisions are growing. The Fed is expected to leave the benchmark rate alone at 4.25 to 4.5, continuing its current stance from recent meeting. Some want cuts now, others see inflation risks. Meanwhile, the market is pricing in rate relief by fall. I see a 1/4 point drop by the fall, maybe 50 basis point drop by December. But I could be wrong. I mean, just pulling that out of the air. Will Powell hold the line, or will he cave to pressure from Trump? President Trump wants the Fed to dramatically lower rates, even suggesting 1% to make borrowing cheaper. That'd be nice, right? But Fed officials say that kind of cut would be risky given current inflation economic debt. I agree 100%. But I don't see a problem with a 1/4 point cut or 50 basis point rate cut from 4.5 to 4. The impact on bonds, they would have lower yields. So you got to lock in those bond yields now. Like buy a 2-year instead of a 1-year. Mortgages, you may want to refinance it for rates drop. And for savings rates, you may want to lock in higher rates for longer. The economy is growing and unemployment is remaining low. So there's no clear reason to ease policy dramatically or to change policy. There's no clear reason to change policy dramatically. How investors can prepare for rate uncertainty, like I said, lock in higher rates for longer. Because I think eventually we're going to see the market soften and interest rates go down. While no changes this week, the Fed left open the possibility of a modest rate cut in September. I could definitely see a quarter point if inflation cools and the labor market weakens. When should you move money into bonds or CDs versus stocks? A listener has shared. Listener question. When should you move money into bonds or CDs versus stocks? Well, it depends. I always say there's 5 types of people that I see. An aggressive person who's okay to just let the market ride out. Then you shouldn't really move money more than emergency fund or 1 to 3 years of living expenses, what I call volatility buffer. Then there's somebody that I would call a moderate aggressive person. That's those of you who have 20% in the market or 20% in the bond market as a hedge, 80% in the stock market. Then there's the moderate investor, 40% in bonds, 60% in stocks. Then the moderate conservative person. You're almost conservative, but you're not so conservative. You want to make a little bit more than the conservative person. That would be about 40% in equities, 60% in bonds. And then the conservative person, 80% in bonds, treasuries, those types of things, 20% in stocks. Who are you? And is your portfolio right for you and your risk tolerance? Get your portfolio scored. We've had people call us at 888-988-JOSH, and they've been shocked at how risky their portfolio was. They did not properly risk score their portfolio from a standpoint of risk. And you want to help build a plan that works whether rates rise or fall? Let's chat. Get your legendary retirement game plan today. Call us at 888-988-JOSH. Now, what signs do you want to watch to predict the Fed's next move? Well, we'll talk about that when we return. This is Josh Jelinski, the financial quarterback. Don't touch that dial. And we're back. When should you move money? What signs do you watch for to predict the Fed's next move? Well, I would want to see the stock market fall by a little bit, 10%, 15, 20, 5. That would be one move where the Fed might lower rates or inflation cooling, or there not being a link between tariffs and inflation. So watch that. I think the data is inconclusive. That's why Powell hasn't raised rates yet, hasn't lowered rates yet. Now, blockbuster earnings from big tech will give us a big test. There is an earnings tsunami powered by Apple, Microsoft, Meta, NVIDIA, powering U.S. markets, but growing headwinds and seasonal trends could test tech's upward momentum. This summer, tech stocks have led the charge, fueling record highs for the NASDAQ and S&P 500. The mega cap leaders like Meta, Apple, Microsoft, NVIDIA delivered strong earnings, fueled by optimism around AI. Yet investors remain cautious because the market's overvalued by many metrics, such as the Buffett indicator, and breadth is narrowing. And seasonal patterns suggest August could bring a pullback. Watch for upcoming jobs and inflation reports and whether central bankers remain patient on a rate cut. Earnings are driving this rally. Apple posted stellar revenue of $94 billion, beating estimates and offsetting over $800 million in tariff costs. Services growth hit an all-time high. Microsoft and Meta delivered blowout earnings fueled by cloud and AI. Who's lifting the market? Now, this is interesting. Only 3 of the Mag 7, those 7 big stocks, Facebook or Meta, Apple, NVIDIA, Google, Microsoft, Apple, Tesla, Amazon, Only NVIDIA, Microsoft, and Meta have climbed past their 2024 highs. Others are remaining range-bound, which underscores the underlying breadth concerns. Apple struggled this year, their stock. AI boom is fueling valuations. NVIDIA surged to over a $4 trillion market cap as AI chip demand continues to explode. Analysts are expecting AI-related stocks like Alphabet, Palantir, and Salesforce to keep driving tech's expansion in 2025. Now, August could give us seasonal trends and macroeconomic certainties that often weigh on tech in August. With tiny risk premium, high leverage, and overvaluations, a correction could become more likely if the market breadth deteriorates further. Which tech sectors are most vulnerable if inflation flares up? Well, obviously chips and cloud and things that are less, where they are importing different things, and they're importing silicon, they're importing materials. I think, should investors adjust exposure ahead of seasonal weakness in August? I think if you are concerned about the market and you can't ride out a 10 or 20% drawdown, yes. But if you can certainly stay the course. But I would look and see, well, what does each constituent of your portfolio do? Do you have tech? Do you have growth? Do you have utilities? Do you have consumer staple? Do you have real estate? Do you have bonds? Do you have international? So it's not just about having the Mag 7. So if you want to review your exposure to tech and see if you are vulnerable to the August swoons that come about historically, book a strategy call. It's called the Legendary Retirement Game Plan at Jelinski.com, or dial 888-988-JOSH, 888-988-JOSH. We'll be back after these messages with an economic check-in. Is the U.S. really growing, or is it a mirage? Up next, this is Josh Jelinski, the financial quarterback. Don't touch that dial. And call me right now at 888-988-JOSH for the book Retirement Reality Check. It is a free gift when you schedule and keep your no-obligation review. Give us a call now, 888-988-JOSH, 888-988-JOSH. And up next, we're talking about whatever questions you have. We're live on X. If you have a question on X, you can tweet out the post, or you can actually go into our live chat, type a question, and make sure you subscribe to our podcast on Apple or Spotify. Hit the subscribe button, hit the follow button. Go to youtube.com, subscribe for the financial quarterback. Is the U.S. really growing? According to Politico.com and CNBC, GDP grew by 3%. But the underlying economy might be far weaker than it looks. Despite stronger GDP numbers, many economists estimate real activity closer to 0.5%. Consumer debt is high. People are ringing up those credit cards. Inflation is sticky. And slowing industrial output suggests softness beneath the surface. GDP jumped 3% for the second quarter, better than 2.3% estimate, and reversing a 0.5% decline in the prior period. Consumer spending rose 1.4% in the second quarter, better than 0.5% in the prior period. And despite the headline number, the fundamental economy seems to be slowing. When you strip out trade disruptions and one-off effects, the real domestic economy grew at just 1.2%, the slowest pace since early 2022. Going back to what we talked earlier about, the stronger headline GDP gives policymakers pause. But weak underlying growth and easing inflation keep the door open to possible rate cuts this fall, depending on upcoming data. Portfolio implications if growth slows. If economic growth slows, it can have a big impact on how your investment portfolio performs and how it should be positioned. How do you structure a portfolio to weather a surprise slowdown? Well, you could add into your treasuries, 1-year treasuries. You look at adding a gold component, adding a international bond exposure. You could even add in things like annuities, which have good yields right now. Fixed annuities are yielding something like 5% right now. Something called a MIGA is over 5% right now. No internal fees. Now it is subject to a surrender charge schedule. So if you pick a 5-year program, you're getting a 5.5% rate, or 5.4 or 5.2, depending on the company, rate locked in for 5 years with no internal charges. Now you got to keep your money there for 5 years, but you can make sure you add a 10% penalty-free withdrawal provision, and that could be a way to structure your portfolio to weather a surprise slowdown. What other sectors tend to do well in low growth, low rate environments? Well, you could look at consumer staples, utilities, energy, things like that. And that's why you should call us at 888-988-JOSH during the break, 888-988-5674, and request your legendary retirement game plan. Visit Jelinski.com today. And we're back. Community response and fundraising after a tragedy. After a deadly attack in Midtown Manhattan, Barstool Sports founder Davey Day Trader Portnoy has stepped forward with a meaningful philanthropic effort to help raise funds for the family of fallen NYPD officer Didarul Islam. You know what's crazy? More and more people are dying in the city. Have you been hearing about this? I have no desire to go to New York City anymore. Isn't that sad? Have you heard about this, Jim?
No. But I
There was
wouldn't
a
go to New York City.
BlackRock executive, or Blackstone executive.
Oh, yes, the shooting, the guy that went with
Shot.
the rifle.
And there's a lot of issues here. 345 Park Avenue, Officer Islam, an off-duty security detail, was killed protecting innocent lives. To support his grieving family, Dave Portnoy launched a fundraiser through Barstool's Back the Blue merchandise campaign. He pledged to match every dollar raised and includes Officer Islam's name and precinct on the apparel as a tribute. This mirrors efforts by Portnoy to raise over $1.5 million for another fallen officer's family in Queens last year. How this campaign reflects broader public and private sectors to support first responders' family, and our heart goes out to the victims of that horrible shooting. Was it the same shooting that impacted, so many lives lost? It was sad. Meaningful charity work can resonate beyond politics or media brands, fostering real community healing and developing brand loyalty. Now, here's a lesson for your organization and individuals. Take a page from Day Trader Portnoy. Do you watch that guy's pizza thing?
No.
You don't watch him?
I've heard about it, though.
The
I've never
one
watched
bite,
it.
everybody knows the rules, and the guy eats the pizza. We got to go tour his favorite places. But it gives you, he's kind of a brash individual, and you might have a negative view of him, but his quick action and transparent matching donations in public display kind of helps his PR. So that's a lesson for organizations and individuals. Now, how can purpose-driven philanthropy, and I think we're going to see more of this in the coming years, purpose-driven philanthropy will strengthen a company's brand loyalty. And can doing good also be good business without it being seen as opportunistic? I don't think it's necessarily opportunistic by Davey, even though he's kind of an opportunist.
Mhm.
I think it's good that he's doing it. And even if it is opportunistic, hey, I'd rather money go privately um, than our tax dollars go fund it. If he can raise, $1.5 million like he did for the other fallen officer in Queens a year ago, why not, right? That's a good thing.
Yeah.
But, I'm sure he does it, because he cares, but he also, the PR doesn't hurt for him. It's sad though that every act of goodness by somebody though is met by, oh, he's doing it for PR. I'm not gonna, cast aspersions on the guy's motive. You know what I mean?
You don't know his motive, yeah.
I don't know his motive, but God bless him. Whatever, I care about the result. I'm gonna give you all a wake-up call when we return after the break at 888-988-JOSH, 888-988-5674. But before we do, one thing we could consider in this age of corporate philanthropy and people living up for causes is, what about your financial firm? Do you appreciate the causes that are near and dear to their heart? Do you want a financial firm that cares equally about your values? Call us. A lot of financial firms, they give to causes that might be totally opposed to what you value. Right, Jim?
Yep.
Hear what these banks do and this group and that group. And people, were incensed by Wall Street in 2008. But you know what? We are a Main Street-based financial firm with regular people managing your money every day, getting up, caring for you and what makes you tick. So call us, 888-988-JOSH, for the values and money discussion. 888-988-JOSH, 45-minute legendary retirement game plan. Call us now, 888-988-JOSH, 888-988-5674. I'm going to give you a wake-up call, a healthcare wake-up call. You need to plan your retirement for a 6-figure bill. New data is showing retirees may face over $370K in healthcare costs after leaving the workforce. $370 grand. Are you prepared for that, Jim?
I won't be here.
I don't know. My personal idea is, I think that number is, I've heard numbers like this for years, and it's quite shocking. Also, this just in, latest jobs report, big job gains, so we're not heading into a recession. Unemployment did tick up a little bit, 4.2 up from 4.1. Just so you know, that is a bad sign.
Uh-oh.
According to Stan Harley. He did all this analysis. Remember this?
Mm-hmm.
And what he said was that a negative sign is typically an uptick in unemployment, even if it's slight. Watch what happens 6 months from then, that we could have a little downturn. He had all these reasons. I'm not going to go into it, but I did see that one time. So, but that kind of fits with my be careful of the not the Ides of March, but next January. I'm a little concerned about next January. Not really, I think the market is strong now, but Fidelity just did a new study that the average 65-year-old couple today will need $383 grand to cover healthcare costs in retirement. And that doesn't include long-term care. With inflation and longer living expectancies, those numbers could grow. What are your practical steps that you are taking to prepare? And what are practical steps that retirees and working adults can take to prepare? Back in 2002, Fidelity estimated this to be around 80 grand. Now it is almost 5 times that amount. What costs are included in the $383,000 estimate? Typical Medicare costs, Part A, B, drug plan, D, premiums, copays, and out-of-pocket costs. But it does not include long-term care, dental, vision. So if you want to see and have decent teeth, it doesn't include that. Or supplemental insurance. Those are more. All of this is your reminder. If you haven't started saving, start. 17% of soon-to-be retirees will have done nothing to plan for healthcare-related expenses. I would argue that healthcare-related expenses are almost more important than retirement planning in and of itself. Because you could always work longer, right? If you have your health. Among Gen X, roughly 1 in 4 has no plan. 17% of soon-to-be retirees have done nothing to plan. And 1 in 4 have no plan at all. The cost of healthcare in retirement has soared and needs to be baked into retirement plans early. What can you do? You can look at an HSA, a health care savings account. You could look at buying long-term care insurance. Look at buying life insurance with a long-term care rider. How do we help our clients plan for unpredictable healthcare costs? Well, one, you could look at buying long-term care insurance. It's a lot more inexpensive than people think. Number 2, life insurance with a long-term care rider. Or 3, annuities with long-term care riders built into it if you're uninsurable. Now, should people in their 30s or 40s, definitely if you're in 50s and 60s, you should be planning for this. But what about if you're 30 or 40? Should you be saving specifically for healthcare and retirement? What do you think, Jim? The answer is yes. Here's why. You could put in a couple $100 a month into an insurance plan when you're 30, and you'd have like, I don't have the exact numbers in front of me, but you would have a significant amount for long-term care related expenses, and you could do that with life insurance or long-term care, and it really helps when you start younger because you get that compounding. So don't let medical costs compound and catch you off guard. Call 888-988-JOSH to build a legendary retirement healthcare plan as well. It is a smart retirement strategy, and we'll give you my book as a free gift, The Retirement Reality Check, when you schedule and keep your no obligation review. Call us 888-988-JOSH, 888-988-JOSH, 888-988-JOSH. And up next, we'll be back with Market Mailbag with some listener questions. And Jim, what's on his heart? This is Josh Jelinski, the financial quarterback. Don't touch that dial. And in our final segment, we're going to take your questions on risk, AI, investing, tariffs, whatever. Question number 1. Is now a good time to take profits? Well, it depends. If you are the type that gets worried about the market, take 20%. Buy something more conservative. Take some profits off the table. You never felt bad about ringing the cash register. Unless you're the type of person who's going to be annoyed. You know, here's the thing with people trading stock, right, Jim? They don't like when it goes down, and they don't like when they sell it. You can't be that person. If you bought a stock and you put in $5,000, and it's now worth $10,000, it never hurt anybody to take some profits. Right, Jim?
Yeah.
But you know what? People get the case of the compare. Oh, what if it goes up to 20? Well, what if it does? What if it goes down to 2,500? You don't know. But take some profits sometimes. Go on a trip. Enjoy yourself. Is now a good time to take profits? Yes. But so is, 6 months from now. How do you invest if you're worried about another trade war? Well, you got to invest anyway, because you know what? There's an interesting phenomenon here that Trump has used, which will hurl us into a different world order. Donald Trump, whether you like him or not, is one of the most consequential presidents in the last 100 years. Why? He's instituting trade wars as a method of economic warfare. I think it's dangerous because what happens when a country wants to get back at us, right, Jim?
Yeah.
They're going to say, okay, well, let's say we really need maple syrup or Canadian beef. Let's say there's a beef shortage in the U.S., lower 48,
I'd be very upset.
and we need to get our steak from the Canadian cows. What if they say there's a 90% increase? I don't like that method of economic warfare because I think ultimately it could be used against us. Those countries could say, you know what, we're going to create the brick currency. We're going to forget the U.S. So I think it could speed up. I'm not saying I don't. I've often said I don't like the tariffs, but I'm open-minded. And we get a listener feedback from one of my dear friends. He says other countries have used this as economic warfare against us. That is the reason for doing that. I get that. But is that, like if you get in trouble from your mom because, Johnny hit me, so I hit Johnny, doesn't always work that way. It doesn't always work the way intended. Also, economics teaches us the law of unintended consequences. So I know why we're doing it, but maybe it's a way to raise revenue for the government to retire the debt. I'm not totally opposed, but it's a new experiment, right? So we got to see does it work or not. Hope that helps you. Give us a call today, 888-988-JOSH. Any other questions from you, Jim?
No, I think he's trying to bring in manufacturing back into our country. Maybe he's going to pressure them to start manufacturing, all the cars or whatever, instead of them paying all these tariffs.
Yeah, the whole concept of reshoring. I mean, I'm aware of the reasoning. I mean, just how many kids are going to work at these factories? It's like they're going to go, I want to be a social media influencer, Dad. I want to be on YouTube. I don't want to be making a car. I think we're going to have labor shortages with this reshoring strategy, but we'll see. If you got more questions and we could answer today, or you want your personalized strategy session, it's a one-on-one. You can meet us in our corporate headquarters in Toms River, New Jersey. We meet people in Princeton, Hackensack, around the country. If you're listening to my voice, we can meet you through Zoom. Give us a call, 888-988-JOSH, 888-988-JOSH, 888-988-JOSH. And a reminder, we're taking your calls, 888-988-JOSH. I want to thank you for tuning in to the Financial Quarterback. Remember, your wealth isn't built by chance, it's built by choice. Subscribe to our YouTube channel at youtube.com. Search for Financial Quarterback or The Financial Quarterback. Catch the podcast on Apple Podcasts, Spotify. Follow us on X at Your Financial QB, or wherever you listen to podcasts. And don't forget to leave us a 5-star review. And call us, 888-988-JOSH, for your free 5 investing plays session covering tax smart investing, estate and legacy planning, income strategies, healthcare strategies, long-term care strategies, and what to do with your investments for growth or protection in these uncertain times. Until next time, stay smart, stay curious, and get in the game. Get off the sidelines of your own financial wealth. This is Josh Jelinski, The Financial Quarterback. Don't touch that dial. Okay, we're done.